I'm Tabitha Rock.
And I'm Sam Davenport.
Born and bred in Melbourne, we live and breathe property, and we know the Melbourne market like the back of our hand. We've both been buying and selling real estate in Metro Melbourne for over 2 decades combined, and we've learned a few lessons along the way.
We're back, baby, with Kayne Conway for the Property Culture Podcast for that sweet taxation advice.
Yes.
Aren't we excited?
We are so pumped. The accountant with
The
knowledge.
Kayne Conway from...
Ibbotson and Moscatelli.
Yeah.
It's always a tongue twister for me. I don't know. I've been working with these guys for a long time.
It's got a lot of letters.
There's
It
a lot
does.
of double B's and M's and
it's
O's
the
and
way,
I's.
it's the way that their branding is combined. It's it's all combined,
I
sort
said,
of. Is that
Kayne,
right?
when are you getting your name on the door so we can F off these bloody long-winded Italian names? Conway's much easier.
I love them. Yeah, but it sounds so regal and old school.
Yeah, does it?
Costas. Costas the accountant.
It's not. Oh, my dear God. Anyway, we are
gosh.
digressing big time.
But for all those who listened to our last episode, we're back with Kayne in the studio talking about investment strategies from a taxation perspective.
Yes.
For the investors in the room or in their cars or in their homes.
Yes.
Whatever you're doing while you're
Vacuuming.
listening. I was about to say vacuuming.
Yeah.
But can you hear it?
I think you can. You know,
If it's
I
in the
just
thing.
bought noise-cancelling headphones for the trip that I did over Christmas, and they're a real game changer. They
Really?
hit different than the old AirPod things.
Yeah.
Oh, they're really, you can't hear anything. That's why when I see women walk down the street with them on, I'm like, that's not safe.
Well, they're not safe for your brain. You
I
shouldn't
think it's
wear that. You
Well,
shouldn't
I
wear
think-
wireless earphones. That's like really bad for your
now
brain.
you're going to start talking about NBN and bloody
5G.
5G, and we're all dead anyway,
No,
really.
I think so, yeah.
Anyway, let's get stuck into it because I think this is going to be a really interesting
Yes.
episode for a lot of people, whether you want to become an investor in residential real estate in Victoria or across Australia, or if you currently are an investor and you're like sitting there thinking, what the hell am I doing? Should I pull the parachute and get out or hold on? I think there's so many considerations that need to be had and conversations that need to be had with your accountant. People always just leave them off the call sheet. You know, it's
Yeah.
Until 30th of June, yeah.
It can be frustrating because, yes, it's if a property's been sold 9 months earlier, one of the problems we often see that, okay, well, you've sold that property and there may or may not be tax to pay. And if there is, do you still have that money or have you turned around and bought another property? In which case, if that money's tied up in the next property you've bought, but you still owe some to the tax man, much better to know that beforehand before making that next decision.
So from an investor's perspective, one of their first points of call pre-purchase or pre-sale of any property should be their accountant.
Absolutely.
Yeah.
If this is not the house, the property that they are living in, it will be subject to tax.
Yes.
So how much that will be, when it will be payable, if there's anything that can be done to reduce it, that's all stuff that you need to do kind of beforehand. You can't go back in time and recreate the wheel on those things.
Yeah.
And that is also around in what name you buy the property in. You can't go back and recreate that because it can be expensive. If you do that, there's, I think, is it stamp duty you have to
get potentially double stamp duty. So, yeah, certainly one of the most important conversations you can have is, okay, I'm going to buy this property. In what name and in what style of entity am I going to buy this property?
Right.
And if I've got a Victorian accountant, can still help me if I'm buying in Brisbane around what I should buy that property in?
Yeah, absolutely. Yeah.
Okay. And the options are trusts, companies. What are the advantages? What are the options?
The three main options. Oh, there's a fourth one which I'll touch on as well, I guess. The three main ones, would be in your individual name.
Yeah.
Now again, there's a couple of different factors there. It's potentially a bad thing from a risk management perspective. I think we touched on in the previous episode around being a business owner. And if I'm employing people and if I've got a retail store or a construction company and someone trips over and breaks their neck and sues me, then I want to have as few assets in my own name. But similarly, on the flip side to that is that investment property could, if it's in your own name, at some point become your main residence, and you then are able to take advantage of the tax breaks that you can get there. So it's one of the most difficult things is that whatever is the right situation for now isn't necessarily going to be the right thing for 5 years' time or 10 years' time.
And is that due to personal circumstances, or is that more due to government changes in tax legislation?
Both. So, yeah, whatever your circumstances are now, this could be the right situation and what the laws are now. But, yeah, 10 years' time, you might have a completely different set of circumstances. You've divorced, or you've married, you've got kids now, you didn't, all sorts of things. So you can never predict the future, and what we come up with now might not be the best for 10 years' time, but at least we've given it some thought.
Yeah. So individual name, then trust?
Probably the most common arrangement would be in a trust.
Okay.
So trust, again, I don't own that. So if someone sues me, they can't get their hands on that property. Similarly, it's you've got flexibility from a tax perspective. So if that trust sells the property and or is earning income, you can often have discretion as to who that income goes to. So the most common situation might be where a property is owned and you've got one spouse earning a lower income because they're staying at home looking after the kids, for example. In which case that income can be directed to that lower income spouse and pay less tax.
Right.
Yeah. Okay. And then, and actually just one thing to touch on with trust that I didn't realise, but from a borrowing capacity point of view, it does reduce your borrowing capacity slightly if you do buy under a trust.
It often can be more difficult because, yes, a bank will often lend to me as a salary earner because they see that as a reliable income.
Yeah, maybe $100, but to the trust only $80.
Yeah, so versus this trust, well, what's
that?
Yeah.
What's going to happen?
Cool.
Yeah.
So individual name, trust, and company.
Is
that the last?
Companies probably less so.
Okay.
Now companies pay tax at 30%.
Yeah.
So sort of from an income perspective, if rental income is being earned, 30% is probably a pretty good rate of tax to be paying compared to the higher individual marginal rates,
Which is
47% can be the top marginal rate of tax that you'll pay.
Yeah.
So 30% is better than 47.
Yeah.
But if you sell the property, and often the most money is made on a property when it is sold, the capital gain, a company doesn't get the 50% capital gains discount. So it will pay 30% tax on the full gain versus if it's owned in a trust or an individual, they do get that 50% discount.
And only pay tax on the 50%.
That's right.
Yeah.
So you're effectively paying tax at 23.5%.
Versus
47 because you're only paying tax on half the gain. So 23.5% is better than 30.
Better than 30. Yeah.
So usually companies aren't the best one. It's not common. It does happen. And again, there could be good reasons why. But yeah, have a chat to your accountant.
And did you mention that there was a fourth?
Yeah, probably superannuation would be the other area. So self-managed super funds have come in and out of vogue a little bit.
Yeah.
But they're certainly very tax effective. There's a lot of paperwork and there's they're highly regulated because it is a very low tax environment. So as a result, there are a lot of regulations that go with it, and it's not a decision to be made lightly. You want to have some good advice and be buying the right property because it is your superannuation funds that you would be using, but certainly a very tax effective environment to do to purchase property in potentially.
Because the tax rate are usually set at what?
Well, it's only 15% for your superannuation fund.
Yeah.
And then even better, when you retire. So retiring for superannuation and tax purposes is different from kind of what we all consider retirement.
Yeah.
But yeah, you can retire and then at that point in your superannuation fund, it pays 0% tax. So entirely tax-free.
So in selling the property and investment property through your superannuation, if you're over 55.
If you're over 60.
If you're over 60, sorry.
Yep.
Then you don't pay any tax.
Potentially.
See,
Yeah.
it speaks very loudly.
But I mean, what would you say is the minimum balance someone needs to have in there?
This
Yeah.
is a bit of this is a sort of $1 million question. In that, it's changed over the years, a few years, and again, you'll get different answers from different accountants and different people, different financial planners. But you probably want to be really looking at close to $500,000, I think,
Sitting in there before buying any
before
form
you're
of property.
looking at using a self-managed super fund for the costs and so forth that go with it. For it to be a cost-effective thing to use, you probably want to have around that mark, I think.
Yeah.
Okay.
But again, you get a lot more flexibility with that than you would with your industry fund, for example.
Right. Yeah, of course.
It's
You
up
can
to
choose. Yeah,
You
exactly.
get to do with it what you
get
want
to
to do.
choose your investment. Yeah.
And what would you say is the number of like the portion of people that buy residential versus commercial in their self-managed super fund? Because a lot of the clients we come across, they're wanting just to predominantly buy commercial property in their self-managed super fund. Is that because why do you find that? And
that would be the majority, not the overwhelming majority, but probably 60%. Probably. Usually that is because that business, that commercial property that they're buying in there is the business property that they run in their business out of.
Right.
Oh, yeah.
So that way they can pay rent to themselves.
Yes. And keep it in
And be
the
in control
self-managed
of
super
it.
fund.
Yeah,
Keep
so
the rent in the
they can be their landlord, have it in the superannuation fund.
Yeah.
They're claiming a deduction for the rent at their business rate,
Right.
and they're paying tax on the rental income
Yeah.
at 15% in the superannuation fund. So it's tax effective, and you're then in control of your own commercial business property. You're not going to have a landlord who's going to kick you out, and potentially a good long-term investment.
Yeah.
For your retirement.
That is interesting because I wonder whether that has had a flow-on effect to investors who are buying through their self-managed super fund who are choosing commercially zoned property, whether that perception of why it's actually beneficial has flowed on to the majority or the masses who aren't then using those properties for their own businesses, but maybe they've just heard that that's what people are doing. So now they're also buying commercial property because we have had everyone who we've bought through SMSF has bought a commercial property.
Yeah.
And none of them are running a business out of there.
No.
So, I wonder whether that's it's just sort of along the grapevine. They've heard the benefit, but they're not quite catching on exactly what the benefit was.
Yeah, and again, I think that's why you should be having conversations with, all right, not only the person who's recommending you buy this property, the agent, but your accountant as well and your financial planner. Is like, does this fit your entire plan? Or is it just a good idea? Does that real estate agent want you to buy it? Well, because he wants you to buy it. He's going to get a commission.
Yeah, exactly.
Yeah.
Oh, he's going to eat for the next month.
Yeah. And so when we think investment property, there's a few terms, buzzwords that always come up. One being gearing, positive, negative, neutrally geared. And the other one, obviously, capital gains tax, which we've spoken about. In the 4 different ownership, it's sounding like capital gains tax is payable just at various degrees. Is that the same with negative and positive gearing? Does that happen in all those 4 different structures to varying degrees? And because I know that, since I couldn't buy in the trust, it actually all worked out well because then it went in my personal name and now I've been able to get some negative gearing through that property. Is that does that only happen if it's in your personal name or does gearing happen
it
across
happens
the board?
Across the board. So, whether or not it's negative or positive, it's just is the property currently turning a rental profit or loss?
Yeah.
Okay.
So in any entity that it's in, if it's negatively geared, to the extent that property is making a loss, that will offset any other income that is being earned. So the standard example that everyone thinks of is in their own personal name. I'm going to negatively gear this property.
Yeah.
Okay, so if that means if I'm losing $10,000 a year on this property, it's costing me that much more than that I'm earning, then that $10,000 comes off my wages.
Yeah.
So all right, it isn't costing me $10,000. It cost me $10,000 less how much tax I've saved. So let's say
30 to 47.
Let's say you're getting $3,000 tax benefit out of that $10,000 deduction.
Right.
Well, it doesn't cost you 10, it
Cost you
$7.
$7. So why are people so obsessed with it?
People love it, and I think that people get a bit too excited about it.
Yeah, because I think people don't think about the dollar figure.
Yeah, I'm negatively geared. I'm getting a tax saving, but you're still out of pocket.
Yeah.
So the only time it makes sense is, all right, my simple example, you're $7,000 a year out of pocket after the tax saving.
Yeah.
Well, as long as that property is increasing in value by more than $7,000 a year, you're in front.
You're in front. Yeah.
Yeah. So you got to look at the two sides of it. Okay, you can negatively gear and get some tax saving, and that helps you but you are out of pocket. So, but as long as the property's going up in value by more than that, then it makes some sense.
Yeah. And I think that's why, and we'll touch on, what you're seeing in terms of your clients and selling their investment properties or holding. But people think, when I chat to some people, they're like, no, my property is positively geared, and they only consider the interest, like the income versus the payment, how much the mortgage. And I'm like, no, it includes your rates, your water, your property management, and now the compliance, which in Victoria especially has like doubled the amount of compliance checks. I mean, electricians are laughing all the way to the bank. They're loving the government's new laws around that. But when you're talking negative or positively geared, it has to take into account all those expenses versus the income.
Yeah, it's easier to sort of look at just some of the headline figures and think this is a good or a bad thing, but there's more to it, and you should be looking at the entire picture for the kind of current year's tax on your income, and as well as, all right, what am I going to do in the long term, buying or selling, and the capital gains tax that goes with that.
Yeah. And on that sort of other end of the spectrum of positively geared, obviously I'm assuming that whatever figure it is that they're ahead, they're adding that to their income for the year.
Right.
So now they're in a different tax bracket, Yeah. So you'd rather be in a position where you're neutrally geared, perhaps, than positive.
Well, the benefit of again, where you get your real and actual tax savings is on the capital growth.
Exactly.
Because you do get a 50% discount. So you know what? Half of the increase in the property, you're not paying tax on that.
Yeah.
So that's kind of where you that's where people kind of are happy to sit there and negatively gear for over a number of years, because it's costing me X amount, but if it's cost me 70 grand over 10 years because it's 7 grand a year that I'm out of pocket, but I then turn around and make $150,000 profit. Well, half that $150,000 profit you've got for nothing.
Yeah, exactly.
So that's $75,000 completely tax free, which offsets all that other stuff you've made. So that's where the benefit comes.
Yeah. But I think also people need to consider that, once upon a time in Melbourne, we saw properties double every 10 years, but that is not really the case. Like that's a very small portion, and that is if they have done works to the property, you might see that uplift. But there's so many considerations, I believe, that people need to have when considering investment properties, and when to consider selling them, holding them. As you said in the previous episode, if you're that upsizer, young professional couple, and you've got the little flat and you're thinking about buying the bigger home, what to do with that property, whether to hold it. And you just need to drill down on a spreadsheet.
Yeah.
And can you drill down with?
Yeah. And look, sometimes it is a bit boring.
Yeah.
In this sort of stuff, it is just crunching the numbers and kind of going, you know what? I think we mentioned there earlier is that you can have some flexibility around which home you choose to be your main residence.
Yeah.
And depending on how property values have gone up and what's happened, and where you're living now and what have you done with the previous one, you could choose maybe actually do I say that old flat that I used to live in for tax purposes, let's treat that for my main residence for a little bit longer. And so there are some things you can do, and fundamentally, what we're talking about here is saving money and saving tax.
Exactly.
And that just turns into a number crunching exercise of, all right, if I do this, what does that turn into?
Yeah.
If I do that, how much do I pay?
Oh, you say it's boring. I get so excited when I've got a meeting with you. I'm like, how much money is Kayne going to save me? Get excited about those conversations with your accountant, because that our conversation with your accountant could be 50 grand.
And
Yeah.
what are the most common expenses and deductions that people just forget to consider?
For their rental property?
Yeah.
Well, probably they don't forget. They probably include too many, if anything, sometimes.
Right.
Yeah.
No, but in all seriousness, well, there's probably two things that jump to mind is depreciation.
Yeah.
So,
Yes. Oh my gosh, I just had
the best thing
this
about
happen on me.
depreciation is that it's a non-cash expense. You go purchase a depreciation schedule from a quantity surveyor.
Yeah.
And they go, all right, this is how much it costs to build this building, and you can then include some of that cost in your tax return.
Yeah.
So, all right, there's a deduction you're getting, and the cost of that report is tax deductible as well.
Yes. Yeah.
Oh, I love those reports. So my first property I bought, I could do the depreciation report. It was worthwhile. The second property I bought, because it's going to be knocked down, they're like, don't bother. And then the third one I did a renovation on, and I could literally line item every single thing that I purchased for the place. Like I did kitchen, bathroom, reno. It was fantastic. And you get the depreciation for 5-6 years.
Well, a lot quicker, yeah. Depending on what they've identified. Some of it's written off really quickly, 2-3 years, and then some of it versus the kind of 40 years write-off that you would get otherwise.
So if you're an investor, if you've just purchased a property, contact a quantity surveyor. Like I use BMT.
Yeah,
they're like, $600, $700. They just come out, they get their person, take some photos, come back, spit out the report.
Put it in their little magic box and then it comes out.
Exactly. And you just flick that over to your accountant. And they're really invaluable.
And in terms of that investor who's just purchasing that property, and say, for example, it got renovated 5 years ago and the previous owner was claiming depreciation on that for the last 5 years, is there ever a situation where that new purchaser is no longer, there's no more depreciation eligible?
Yeah, they actually did change the rules a little bit on that relatively recently. So it used to be, everyone was kind of getting a double bite of the cherry. That you bought it and you got a report, and I buy it and I get a report, and I reclaim all those deductions. So they have scaled it back a bit, but it is potentially still worth it from the building costs perspective.
Yes.
So not necessarily
depending on the
you
level
won't
of
necessarily
works.
get the dishwasher and the inbuilt fridge anymore because that's already been written off.
Yes.
But there's some capital work stuff there.
How do you know that it was written off by the?
You don't. So they've just largely canned it on, unless it's a new build, you don't get a lot of that stuff. But the stuff that is still eligible for ones you've purchased, it's potentially still worth it.
Yeah. Okay. And so, I mean, this brings us to the question, what are you seeing your clients do with investment properties, or what's investment property conversations looking like right now? From obviously we're in the Melbourne market, Victorian market, but also nationwide. Are you seeing people excited by investment properties? Are you seeing them more excited by shares at the moment?
Well, everyone was excited about US tech stocks until yesterday. But no, look, it's
yesterday. This podcast is coming out in a few.
I do forget that we're not live. Call in 1-300.
Yeah, exactly.
Oh my God, he's so comfortable. He's going to be back next week.
Look, I think from an investment property perspective, it's people tend to be going, you know what? Because it's not just Victoria. It's like land tax and all these things. That there's versions of them everywhere. So people, if they are looking to acquire multiple properties, will often be do it in different states.
Yeah.
Okay. So you know what? I've got a couple of properties here in Victoria. I'm already up at the land tax thresholds, which are starting to get painful. So the next property I'm going to buy is going to be in South Australia.
Yeah.
But I don't want to buy too. But again, I've got the same problem if I buy in New South Wales. Once I get over a certain limit, it starts to get too expensive. So often people are looking around the country as opposed to piling up too many properties in a single state.
Totally. That is exactly what we're seeing. All the investors who are selling up their little properties or whatever properties they own in Victoria just now buying in New South Wales or Queensland or something like that.
And often what we're seeing a little bit of too is not necessarily what I'll call the straight investors, but those people have got that beach house down the peninsula,
Yes.
the family beach house that they've had for 40 years.
Yes.
And all of a sudden now it's worth a bloody fortune.
Oh my God.
And they never used to cost them anything. Now all of a sudden they're getting these whopping great land tax bills. And it's like, hang on, we use it 3 times a year. can we afford to keep the thing? Or so
I've seen that all the time with people getting inheritance.
Yes.
And they're renting places down at the coast out and they're just getting these 20 grand, 50 grand land tax bills.
Yeah. Well,
And
thank God we sell down on the peninsula, guys, right?
It is.
Yeah.
We just sold for multiple clients actually who were in that exact position last year. So it was the third or the fourth or something property or the inherited property for young couples who were like, what are we doing with this when they're worth, often between 1 and 5 mil.
Yeah. And if they're not getting that, necessarily getting that genuine rental income from it.
Exactly.
Well, who's paying for it?
And also traditionally some of the properties down on the coast have not had massive upswing. They did during COVID, but they sort of plod along.
Yes.
So it comes back to that conversation about capital growth and is this a worthwhile investment to hold on to? What's sort of the income and expenditure?
And look at an interesting one too there from an inherited property perspective. That brings its own tax issues about if we do sell it, how much was it bought for and how much tax will we pay? So that can be a bit curly.
Yeah, but tell us about that because so many people our generation are inheriting properties.
Yeah.
Oh, yeah.
That is what's happening. That's what's
shift
going to
of wealth,
happen. Yeah.
generational
Transfer, the old transfer.
Still waiting for it, but
They're saying, darling, but they're saying that we're going to see the biggest transfer of wealth over the next 10 years, and that's due to a lot of the property.
And look, and this without trying, but I'm talking tax minimisation strategy.
Yes.
But you know what? If there's a beach house down there, and if that's someone's main residence, well, you know what? And they pass away.
Yeah.
Then it passes to the inherited. Whoever inherits that is taken to have acquired it at the market value of when the person passed away.
Okay.
So
their land tax or their sort of capital gains tax starts from that purchase price.
If that's just a beach house that no one's lived in, and all right, well, okay,
investment.
Grandma bought that back in 92.
Yeah.
Well, it's whatever she paid for it back in 92 is how much the cost is. So you've got a much bigger capital gains tax exposure there,
right?
Versus if you can potentially plan for these things ahead of time
by
moving in.
Yeah, they're on their deathbed.
Sorry,
hang on, is it the person that's dying or the person that's acquiring?
Acquiring.
Oh, moving in. Okay.
By moving in, the person who's acquired it.
If that's established as someone's main residence before they pass away.
Yeah, the dead are moving in. On the deathbed, you're wheeling them in and sending a picture to the government.
And how long do they have to have lived there for?
Oh my God!
Seriously,
Weekend at Bernie's style.
Seriously.
But
my
again,
gosh! That is insane. That movie. That is 80s to a T, isn't it? Popping around a dead guy.
I don't
Weekend
know
at
what you're
Bernie's.
talking about. I'm not a movie buff.
Yeah, the
but
VHS,
again,
man.
We're kind of
VHS.
We're having joking about it, but you should be genuinely planning for these sorts of things.
So say, for example, when you say genuinely planning, say, for example, so grandma has a beach house.
You would want that to be her main residence anyway. She wouldn't be.
But what
if she's also got another one?
Well, again, this is where you need to be discussing and planning about these things.
Or not retirement village. What if she's also living in her big house in Menzies Creek? And that's her principal place. If she then moves to the beach house to offset tax, but she's
that other one stops being the main
residence.
So again, and again, this depending on what the plans are going to be. If the plan is that property on the beach house is just going to sit there forever and it's always going to be in the house and with no intentions of selling, all right, well, we don't have to have such a conversation about capital gains tax because that's going to be your kid's problem when they inherit it down the line.
Yeah. Capital gains tax on the price from when they purchased it. It's as in if it's always been an investment, the original purchase price.
Yeah.
Oh my God.
I mean, you're getting the money for free though.
Well, that 100%, I believe that you're getting the money for free, but I just hate that, I mean,
the government.
I wish, here's one of my wishes, but one of my 3 wishes of life. No, I've got many. No, but if I think that all tax related to housing should be only able to be used by the government for housing future housing. So
that sector of what the government's doing.
It should stay in the sector. So you want to charge us that much? No worries. So build another, however many low density or, low income earning.
By those shabby builders that you employ. Well done. They probably are paying you under the table.
Do the sprawl. Continue the sprawl, the Melbourne sprawl. Do something with it. But instead it just goes absorbed.
Mm.
So it's like,
Oh, put in a train to the airport while you're at it. Anyway, I'm really digressing. But
it's become a politics podcast.
I
guess it's inevitably going to be with property, though, isn't it?
Well, we try and stay off the politics because
Yeah.
it's so bloody boring and dry and no one knows what's going on. It's like the rate conversation. But I think control what you can control, and that's having the conversations with the right people when you're thinking about buying or selling investment property, or whether you're looking to move from your principal place and whether to convert that into an investment. Have a conversation with your accountant.
I think it's those life events. Yeah. So if someone's passing, someone's getting married, you're moving, you're having kids, have that chat because especially if you've got investment property, there may be things that can be done.
Yeah.
Yeah.
Love it. And we love paying the gov less tax. So speak to Kayne. Give him a buzz. No, thanks so much for joining us. You've got great insights and you also don't speak gibberish that no one understands. So we hope for the listeners it's been interesting. And there's so much more we can cover, but we'll get you back again.
Yeah, look, I try not to caveat too much because it is all down to the individual circumstances.
Exactly. Yeah.
But if you have the conversation in advance, then you're in a position to be able to
make informed decisions. Yeah. Wonderful.
Yeah, no, it's a good point to make. The overarching caveat is that every individual circumstances are going to inform the type of discussion you have.
That's right.
Yeah. All right. You know where we're going because this is part 2. F, marry, kill. Okay.
Give him a tricky one.
Best investment. Property as best investment. Shares as the best investment, or crypto?
As a relatively risk-adverse person, crypto can get F.
It can get killed.
Crypto can jump off the
I love how he does
the
the automatic rule out first. I go with the which one am I marrying first. But he goes with the I'm killing off this straight away, and then he process of elimination.
I also say crypto because I remember about 9 years ago going, I've heard about this Bitcoin. And you had to get on not the dark web, but it was a difficult thing to do.
It was dark enough.
It was sketchy. But and I was going to put a bit in and buy, and I just it was too hard. And geez, if I'd put $1,000 into crypto 10 years ago,
I know.
Bitcoin,
Well, by the time I did it, Bitcoin was too expensive, so I did all those other ones. And I just recently sold it, which it was for a profit. But you look at the volatility of it over the time I had it. My God, who's got the? I don't care enough, to deal with that. Okay, marry an F.
Marry an F. I'll marry property because I like it's tangible. There's something there.
Housing.
But shares I'll take. There's tax credits and all sorts of go with that. So
one night stand kind of
That's
vibe.
what we want to know about. Tax credits.
Well, franking credits, which were a big topic of discussion a couple of election cycles ago. And it's fair to say no one knew what the bloody hell they were talking about.
Franking credits, as in frank as in the original way we referred to money. What's frank?
Exactly.
Well, that wraps up another Property Culture podcast where we know more about property than we do shares. And if you want to know about shares, property, or any taxation advice, call Kayne.
Yeah.
Thanks for joining us again.
Thank you.
Pleasure. Thanks, guys.
Bye.